So how does a bank make 19 billion a month in a pandemic? Let's find out. Hi, folks. Welcome to The Way I See It, which is my podcast on money, personal finance, investing, and what we can learn from these topics. This week, the results from Zenith Bank Plc, one of Nigeria's largest banks, did catch my eye. It caught my eye because it was a very, very good result. But then again, we're used to good results from Zenith. But this was in the year 2020, the year where we had the lockdowns, global economic shutdowns because of the COVID. So we had, no commerce was going on for large parts of the year, especially in Q1, Q2, and I would even say Q3. And the bank was able to post a very, very good result. Yeah. So I said it might be a good idea to just review the Zenith results, see what we can learn from it, if there's some learnings there that we can apply personally, and just talk about Zenith and the banking sector, even Nigeria for a bit by just going through these topics. Yeah. Okay, so the first things first is let's just give ourselves an overview of what Zenith Bank achieved in 2020. Remember what I said? This was the year where we had the lockdowns, where not a lot was really going on. So put that in context when we are able to say to just present these results. By way of gross earnings, so just how much the bank made without taking away fees and cost of doing business. That was the bank made about 696 billion in naira, 696 billion in naira. And that was a growth of about 5.2%. In terms of profit after tax, which is the profit the bank has posted after it has paid the taxation and it has paid the costs of doing business, that was about 230 billion. Again, that's a growth of 10% in 2020, 10% from 2019. What about customer deposits, which is, of course, all the deposits that the bank is able to attract to the bank? That grew to about 5.34 trillion with a T. And that's a 25% year-on-year growth from 2019. So a lot of more deposit that the bank made in the year that the economy was shut down than the normal years. What about total loans? Should we say gross loans? The bank was able to increase its lending to 2.9 trillion. That's 18.6 year-on-year growth. So, if you just look at this result alone, you can see the bank increasing lending in an environment that the local economy had a recession and the local and the global economy had a lockdown. And really all the economies, even China, was at a recession at a point in time. But the bank was able to grow loans, the bank was able to grow deposits, the bank was able to grow earnings, and of course the bank was able to grow profit after tax. That is impressive. So that's the first part. The second part is, what can we learn from this? How can we use it? So it'd be a good idea for us to, look back and ask ourselves, how do banks make money? If we know how banks make money, then we can basically walk back and say, how did the bank do it? And then we can then, of course, learn from that. So banks make money in two main ways. One is interest income. The other is non-interest income. Interest income is just the income the bank makes from the normal course of business. So the bank sets up shop, it attracts deposits, it takes those deposits and it rents them out, or it creates risk assets, which are called loans, more or less, for a fee. So a bank would go to a place, take deposits and lend them on the place, on the individual, and collect a spread or that fee from doing that service. So it charges you an interest more or less when you borrow from the bank. And of course, that's what we call it, interest income. And that's the core function, or the core reason why banks are more or less set up to distribute excess capital between deposits rich and deposit deficient sectors. That's one way of doing it. The other way is the non-interest income, where the bank then says, we're not going to create a deposit, but you will pay us for services. Those services could be investment banking services, whereby we're lending out our brain power or our expertise or our contact, or it could be just you want to use our assets, you want to use our automated teller machines, the ATMs, and we charge you a fee for that. So that's non-interest income. On both counts, the bank made profits on both interest income and non-interest income. The bank grew its non-interest income by 12% in 2020. And of course, grew its non-interest income by 8% in 2020 as well. So in the broad breakdown of how the banks make money, again, we see the bank, coming up tops in both ends. So the question for us now, how do banks make money, or how specifically, how did Zenith Bank post this good result? And if we can find this out, perhaps we can use it ourselves, yeah? So I basically just summarized what Zenith Bank did into four. Number one, Zenith Bank was able to attract cheap deposits. Number two, Zenith Bank was able to achieve a positive spread on those cheap deposits. And number three, they added value. And number four, they had very efficient risk management. Yeah. Now, this is just what all banks do. All banks try to get cheap deposits. All banks try to create a positive spread by lending out those cheap deposits to individuals or institutions. And all banks, of course, want to provide value addition. It diversifies their revenue base. Yeah. And of course, all banks want to basically manage that whole process by implementing sound risk management policies to ensure that they do not have a loss in the normal course of business, or those losses are more or less minimized and do not affect the going concern of the bank. So all banks want to do this, but how has Zenith Bank done it? And this is where I really like how they've, used what they've had in a bad environment to come up tops. So first things first, Zenith Bank was able in 2020 to reduce their total interest expense to about 121 billion. What this means is this: interest expense is what the bank pays to attract deposits. So when you go to the bank and you tell the bank, I want to invest, I want to place money in your bank, they will pay you an interest. Now, the calculation of the summation of all the interest paid for all the deposits is now what was called the total interest expense, more or less, to the bank. So the bank was able to reduce that figure. In 2019, it was about 148 billion, but 2020, they dropped it to about 121 billion. So the bank was able to, like we remember, we said the bank grew its deposits by 25%. But in growing the deposit, it reduced the cost of those deposits, which is very, very important. How did it do this? It did this by changing the types of deposits it collected. Yeah. So before, the bank had a lot of time deposits. Time deposit would mean you go to the bank, you say, hey, I want to fix money. The bank says, okay, if you want to fix money for a year, we're going to pay you 10%. That's a time deposit, So the bank was able to reduce time deposits and to increase current accounts. Why? Because, of course, current accounts don't pay you as much as time deposits. So it was able to drop the time deposits by 38%, and it increased current accounts by 155%. So you can just clearly see their strategy. They got deposits, yes, but they did more deposits in current accounts and in lower interest paying accounts than in the higher interest paying accounts. So that was very, very key for them to then reduce their cost of deposits. Very, very important. But when they got those deposits, what did they do? Again, we've said Zenith Bank grew its net interest, and the net interest income of Zenith Bank grew more or less by 12%. So how did it grow it? Number one, the key thing that happened in Nigeria, I would say, in the 2020 cycle was the fall in interest rates paid by the sovereign, the federal government. You had double-digit rates that were being paid on treasury bills. And of course, you had higher rates that were being paid on bonds. But over the course of the year, the treasury bill rate has just gone down from nearly double-digit to single digits. And what Zenith Bank was able to do was to take its money out of treasury bills and put that money in bonds, in longer dated bonds. So it reduced its exposure from treasury bills. We were not paying as much, and it bought more bonds. So that allowed it to invest the bulk of its cash more or less in assets that were paying a higher yield than assets that were paying a much, much lower yield. That was key because that helped them to contribute to making that 12% return on net interest income in 2020. Very important. And again, the third one, of course, is, providing the value addition. This is how I've tried to identify things that the bank has done to diversify its revenue base, even away from interest and non-interest banking that have just brought funds. In here, I will talk about the revaluation of the Nigerian naira. Just by holding dollar assets, the bank made about 42 billion, which is almost a 256% gain just from financial year 2019, just on the devaluation per se of the Nigerian naira. I was able to post that result. But again, most importantly, the bank was able to do a lot of collections, for clients. And that also gave the bank a lot of, or should we say, underline of business that it could then use to post a good result. So that's an extraordinary item, valuation, and of course collections. Those were two big ones that I saw. They were not core to the bank, i.e., commissions and agency and revaluation, but they did post, or they did allow the bank to make some money in normal course of business. So that was key also for the bank. But I think for me, what was most impressive for me for Zenith Bank was how they did their risk management. So again, Zenith Bank grew total loans by 18% to 2.92 trillion. But it did this in an environment where the non-performing loans figure was going up. So if you could take services, for instance, non-performing loans in services grew from 9% to 24%. And Zenith Bank was big in trade and all that. But again, Zenith Bank was able to lend more, even to those guys, but keep the proportion of non-performing loans very, very low, to about 4.29%. So loans went up, but by percentage of non-performing loans, they were just where they were in 2019. I mean, think about it. This was a year where many sectors just shut down for 6 months or 3 months and didn't do anything. And still, Zenith Bank was able to keep the number of non-performing loans down. That, I think, was very, very, that's a good testament to how strong their risk management is. So, I mean, overall, the bank navigated a very, very difficult year and was able to post, good profits to shareholders, about 3% dividend to shareholders. And of course, the bank did all this by hiring more people. So even as the economy went into a recession and lots of people sadly lost their jobs, Zenith Bank was hiring. Zenith Bank grew its staff strength by 4.6%. Yeah. So I would say a good result, good strategy play out there to see where yields were going to, and going from short to long. That was very, very important. Also good strategy in seeing the fall in deposit rates, i.e. from the government side of treasury bills and going to bonds, and also from going from time deposits to current accounts. Also very, very key. I mean, for us to learn, we would then see that when we have situations occur, it's very important that you review your portfolio with a financial planner. If you had planned to invest in treasury bills because they were risk-free and they were short-term, you could go in, wait 30 days, get them, and then suddenly things changed. You don't have to wait. You just have to go back in there and swap out the portfolio and position it right for you to also reap. If you have a cost, address the cost, cut the cost off, and then move forward, just like what Zenith Bank has done. It won't be an excuse to say because the whole economy is going down, then my portfolio can also go down, because we've seen that they were able to do a bit of risk management to know their customers, know how their customers are hurting, and they try to work with their customers. And again, they try to diversify their revenue base. I mean, if you call devaluation diversification, I mean, it is what it is. Also, collections, able to achieve income from just doing collections and agency. So for us also, we have to diversify. We could diversify in the business we're doing, and also diversify outside the business. In certain case, they didn't open up a cyber cafe or open up a manufacturing plant. They just basically went back to financial services and they try to offer more and more services to those clients we serve. But it's not all rosy for Zenith Bank. I did see a few things that they have to watch for in 2020, like net interest margin when going down. I see the interest income that grew by 12%. If you compare to 2017, it's going down, yeah. And of course, like I said, they got a revaluation gain, which was like some given in terms of revaluation just by holding dollar. So that was a one-off. Maybe should we say it might not happen next year. Naira may or may not be devalued, so they might not get that. So a few red flags here and there that we can watch, but overall, pretty good. I mean, if you owned Zenith Bank, the figures for you should be looking pretty good. I mean, you're getting a dividend of 3%. That's one, and you're also looking at in terms of your return. Let me just give you what I have plugged in here. The dividend yield for Zenith Bank, give or take, is about, if you compare that to Zenith Bank, the PE for Zenith Bank is about 3.49. So the price earnings ratio for Zenith Bank is about 3.49, which means if you buy today's price about 25 naira at the current rate of earnings, it will take you less than 4 years to get your money back, more or less. Yeah, earnings per share of about 7.34. That's earnings per one share. That's not bad. And if you compare that to GTB is about 6.55. So you could say that they're in the same class. GT is selling for about 31 naira. So not bad in terms of Zenith if you compare them together. So in terms of yield, in terms of the cost, it looks like a good one. If you were in it, not only do you get the dividend, you also get a capital appreciation if you had held Zenith Bank during the year. So I would say overall, a few lessons for us to move quick, not to wait, take advantage of the situation, diversify your portfolio, and play the market, know your clients. Those are a few lessons that Zenith Bank has taught us this week. All right, guys, we'll stop here. I hope you guys will keep listening to the podcast and keep sharing and keep sending me those nice questions. I like to hear from you guys all the time. Follow us on Twitter, FinPlan Kalu Aja1. Also follow us on YouTube. That's Kalu Aja on YouTube. And of course, this week we're having a Zoom webinar on debt and getting in and out of debt per se. So I would love to have you guys there. 11 a.m. West African time Zoom webinar that we're going to be hosting. The details are on Twitter. All right, guys. Appreciate you guys staying with me this late. You guys have a good one. I will see you all next week. Have a good day. Bye.